Good afternoon. This is Sean Golding with Golding and Golding, here to kind of briefly and quickly go through how the U.S. income tax system works for U.S. persons. So the U.S. is different than most other countries in the world. The U.S. taxes on their worldwide income. Okay, taxes. It's called Citizen-Based Taxation (CBT), but like everything else, it's not super accurate when it comes from the IRS because citizenship-based taxation also includes the U.S. persons, which would mean lawful permanent residents, and foreign nationals who meet the substantial presence test. Most countries only tax you on your worldwide income if you're a citizen and or resident of that country, reside in that country. The U.S. does it different. Joe is a U.S. citizen. Joe lives in foreign country B. Joe earns all of his money from foreign countries C, D, and E. Even though he's not living in the U.S., even though the money was not earned in the U.S., technically it's sourced in a foreign country. At the end of the day, the U.S. still taxes Joe on his worldwide income. Why? Because he is a citizen of the United States. It doesn't matter where he lives. It doesn't matter where the money is earned. It's taxable. Even though income worldwide is considered taxable, there are legitimate ways to reduce your tax liability depending on your facts and circumstances, where you reside, and if you pay foreign taxes. Let's go through some of the more common. Foreign taxes paid for individuals, and we're not talking about guilty and making 962 elections to claim foreign corporation income taxes paid. Just you're a U.S. person, you have passive income in a foreign country. It's $30,000 a year passive income. You pay $8,000 a year in foreign tax. So some people would say, oh, you just report the $22,000 in the U.S., the difference between the foreign gross and the taxes paid. That's not right. Instead, what you do is you report the $30,000 and you report the foreign tax credit. That way, you may have a sufficient amount of foreign tax credit to apply to your U.S. tax return so you don't end up paying double tax. Okay. When it comes to the foreign tax credit, you don't always get a full dollar for dollar credit. If you paid more tax in the foreign country than you would have paid in the U.S., U.S. government's not going to refund you what you overpaid. Instead, you get a carry forward going forward. If you paid less, then you pay the difference. If you pay the exact same amount, congratulations, an easy tax and accounting exercise. Next thing is the foreign earned income exclusion. There's a lot of confusion with this one. The idea behind it is that if foreign countries are tax home, you're a U.S. person, you don't work for the U.S. government abroad, you can exclude upwards of $110,000, give or take, of your foreign income, as well as a foreign housing exclusion from your tax return. That does not mean you don't file a tax return. What it means is, and that's a very common and understandable misconception, it's kind of like the telephone game. It's been passed around for decades. But the idea is you file your tax return, you include all of your income, and then you claim the foreign earned income exclusion, so that portion of it and the housing, if you qualify, is not going to be taxed, okay? One great thing about the foreign earned income exclusion is that spouses, partner RDPs, they can each take it. So if there's a family, they move overseas, they're making $250,000 a year combined, depending on how that income is split, foreign earned income exclusion, it may come out to a very minimal of any tax liability. So the foreign earned income exclusion is great. The reason why it's so important that you file the return and the exclusion, especially if you used to file returns and maybe stopped, is because the IRS doesn't know you qualify for the exclusion. If you don't file, they don't know that you're working overseas and making money, and that you qualify for the foreign earned income exclusion. So they may start filing SFR, substituted returns. Next thing you know, you've got this tax debt brewing, and you end up getting your passport revoked or denied because you didn't think you had to file, or you just assumed if you're below the threshold you don't have to. Remember, the IRS doesn't know unless you tell them. A more technical sort of way to reduce taxes, sometimes for some taxpayers, is foreign pension, especially if you're a lawful permanent resident and you're living outside of the U.S. in a treaty country, and you may qualify for an exemption so that only the foreign country taxes you on the pension, not the U.S. And if that foreign country doesn't tax you on pension, great, you may be able to escape tax in the U.S. on that income. In addition to the tax, there's also significant reporting requirements. Some of the more common reporting requirements of global assets, accounts, and investments include the FBAR, Foreign Bank and Financial Account Reporting, FinCEN Form 114, FATCA, the Foreign Account Tax Compliance Act for individuals and others who file 1040s. It's a Form 8938. And then you get into the more annoying, complicated stuff. PFICs, passive foreign investment companies, mutual funds, and CCOVs, ETFs would normally qualify for having to file that, unless maybe it's a mirror fund with an insurance policy. You may be able to circumvent or sidestep that. If you receive large foreign gifts, if you have ownership or interest in foreign trusts, foreign businesses, entities, things of that nature, there's a whole slew of reporting requirements you should keep in mind. And the IRS has been known to penalize people on this. And these penalties don't come as a result of unreported income, just non-filing of the form. And while they used to have the delinquency procedures that essentially abated or avoided all penalties, the program changed November 2020, and it's not as lenient as it used to be. If you're out of compliance, if this is all new to you, you want to get into compliance safely, there's various amnesty programs you could do. There's voluntary disclosure program if you're willful, can't certify under penalty of perjury that you're non-willful. There's the streamlined filing compliance procedures, domestic and foreign. Both of them is for foreign money. Domestic is for non-foreign residents. Foreign is for foreign residents. The distinction is important because streamlined foreign is a complete penalty waiver. Streamlined domestic is a 5% penalty. There's always a reasonable cause and delinquency procedures. We have lots of free information available on our main websites and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if you think it's appropriate. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.